Most people think that the stock market is all about numbers. It's not. It's also about stories. Just look at SpaceX. It went public this year at a $1.77 trillion valuation on less than $20 billion in revenue. No reasonable spreadsheet or DCF gets you to that number. A story does. And right now, I think Meta is one of the most misunderstood stories in the market. The stock is down around 25% from its highs on fears that Meta is spending too much on AI infrastructure. So in this video, we're going to cover Meta's CapEx and why I think the market might be misreading this one, the bear points that I actually think investors should worry about, the hidden opportunity for investors in Reality Labs, and finally a few valuation scenarios. But before we get into all of that, I should probably introduce myself. My name is Adi. I'm a long-term fundamental investor. I spent part of my career in finance at companies like Amazon, Booking.com, and Warner Brothers, where I built financial models and helped write investor relations reports. And on this channel, I'm using that experience to break down companies and market trends. So let's start with what has investors so worried. Meta's CapEx hit $31.1 billion this quarter. For the full year, management now guides to $130 to $145 billion of CapEx. To put that in perspective, a few years ago, Meta's entire annual CapEx was in the low 30s. They're now spending that every quarter. And here's the number that spooked investors. Free cash flow this quarter came in at $784 million. That's down about 91% year over year. Meta made roughly $31.9 billion of operating cash flow, and CapEx of $31.1 billion ate almost all of it. And we're starting to see the impact of that CapEx on the income statement. For context, all of those GPUs and data centers don't just hit cash flow when you buy them. They get depreciated over the following years, and that depreciation flows through to the income statement. So even after buying slows down, Meta carries a higher cost base for years. And you can see it starting to show up in the numbers. Total expenses this quarter were about $42 billion, up 55% year over year. Revenue grew 28%, so expenses are growing faster than the top line. Now, some of those expenses are one-offs. There was a $2.4 billion legal charge and about $1.2 billion in severance from the layoffs earlier this year. Strip those out and it's not as ugly. But even adjusting for those one-time impacts, expenses are growing faster than the 28% revenue growth. And that's the whole worry in one sentence. Meta is spending way more than it can justify. Now, that's the bear setup. Let me tell you why I think that's at least partly misguided. The number one criticism I hear is Meta is spending $100+ billion, and they don't even know what they're spending it on. And I just don't think that's true. The more accurate version is they haven't committed to one single killer use case. But that's very different from having no use case. They have a menu of things this compute can go toward. And honestly, having optionality on where to point $100 billion of compute is not a bear point to me. Let's walk through the options Meta has. The first use for all that compute is Meta's core ad business. And it's already working. AI helps Meta figure out what content is most likely to keep people engaged, so it can show them more relevant posts and keep them on the platform for longer. This creates more opportunities to serve ads, helping driving a 14% increase in the impressions. At the same time, AI improves ad targeting, helping Meta show people more relevant ads and deliver better results for advertisers, which help drive a 12% increase in the average price per ad. So some of Meta's AI spending is already paying off in its core business. This isn't speculative, it's happening now. The second use for that compute is Meta's frontier model. And this is where I think the market is being a little inconsistent. Look at OpenAI and Anthropic, private companies valued in the hundreds of billions, potentially $1 trillion, essentially for building frontier AI models. Meta is also building frontier models, and the market seems to assign that effort roughly zero value, arguably negative, because all it sees is the cost. Now, to be fair to the skeptics, OpenAI and Anthropic directly monetize their closed models by charging for access, whereas Meta plans to release some of its models with open weights. But the point still stands. If frontier AI is worth something at OpenAI and Anthropic, it's a little strange that it's worth nothing at Meta. There's an inconsistency there worth pointing out. The third opportunity is selling access to the infrastructure itself. Meta is reportedly exploring an AI cloud business where companies could rent its computing capacity or access models hosted on its servers. And the demand is clearly there. In the latest quarter, AWS revenue grew 37%, Azure grew 43%, and Google Cloud grew 82% year over year. Zuckerberg also said Meta is already getting a lot of offers for its compute at a significant premium to what the company paid for it. So even if Meta ends up building more capacity than it needs internally, that capacity could become a valuable business in its own right. The fourth opportunity is AI agents and business messaging. This is what Zuckerberg spent real time discussing on the call. And here's why I think it's underrated. Meta has barely monetized WhatsApp. and it has north of 3 billion users. That's beginning to change. The family of apps other segment, which includes business messaging, was up 73% this quarter. If AI agents let businesses run sales and support, Meta is about as well positioned as anyone on the planet to monetize that through WhatsApp. So when I put all four together, better ads, a frontier model, a potential cloud business, and AI agents, the fact that they're buying a lot of compute right now doesn't scare me the same way it seems to scare the market. Meta has plenty of places to point that compute. So what happens if they overspend and it doesn't work? Here's how I would frame this. When you buy a stock, you're buying the lifetime value of that company. Every dollar of cash flow it will ever produce discounted back to today. You're holding this thing for a decade, 2 decades. So the right question isn't what did free cash flow do this quarter? It's what did the spending do to a lifetime of cash flows? And when you look at it that way, the numbers are almost trivial. Meta's entire CapEx bill this year will be around $140 billion. Let's say some of these initiatives don't pay off, and Meta ultimately loses about 25% of what it spends, so around $35 billion. That's roughly 2% of the company's market cap, or put another way, about a single quarter of operating cash flow. So all in all, I think the CapEx panic is overdone. Beyond the CapEx debate, here's what I think investors should genuinely worry about. There are really only 4 ways the ad business can grow. More users, more time spent per user, more ads shown during that time, also known as ad load, or a higher price per ad. The first lever, users, is getting close to tapped out. Daily active people grew just 3% this quarter, to 3.6 billion. At that scale, there simply aren't that many people left to add. The second lever is time spent. That's still growing. Instagram time spent increased by double digits, while Facebook video time rose 9% globally. But there's a natural ceiling on here too. There are only 24 hours in a day, and Meta is competing with every other form of entertainment for them. That leaves ad load and pricing. Ad impressions rose 14% this quarter, driven by a combination of more users, higher engagement, and Meta showing more ads within that engagement. And average price per ad increased 12%. So the real question is, how much further can Meta push those final 2 levers? It can only add so many ads before the experience starts to suffer, and pricing can only rise as long as advertisers continue to see strong returns. That, not the CapEx, is the bear case I'd most focused on. Let's quickly discuss Reality Labs before moving on to the valuation. For context, Reality Labs is the division building smart glasses and the metaverse. Now, I don't have any strong views on whether that business will work or not, but I wanted to mention something worth noting. Reality Labs is losing a lot of money. It loses around $20 billion a year, and cumulative losses are around $90 billion. Counterintuitively, that might actually be an upside for the stock. The market pays around $20 of value for every dollar Meta earns. Reality Labs loses $20 billion a year. If that loss just halves, that's around $8 billion back in earnings after adjusting for tax. If we apply, let's say, a 20x multiple to that, around what Meta currently trades at, that could be an additional $160 billion in market cap. So you don't need the metaverse or hardware bets to work. You just need the spending to slow down for this to be an upside. If you're finding this video useful so far, please do consider liking the video and subscribing to the channel. I'll be making plenty more videos like this one in the future. Okay, so now let's look at the valuation. And before I mention a single number, I want to be clear about what this is. I'm not going to build some precise 10-tab discounted cash flow model that predicts the price to 2 decimal places. And here's the thing, neither do some of the great investors. To paraphrase Warren Buffett, if you have to do a detailed calculation to work out if an investment is good or not, it's probably too close to think about. The good investments ought to just scream at you. So that's what this is, some back of the envelope math to see what the potential returns could look like by the end of 2030. So Meta did about $201 billion of revenue in 2025. Let's say 2026 grows around 26%, in line with analyst estimates. Half the year is already actualized, so there isn't that much ambiguity in that number. Then let's assume that growth fades geometrically to about 12% by year 5. That path lands you at $464 billion of revenue in year 5. Now let's look at margins. Meta's net margin has been around 30%. Let's assume that all of that extra depreciation from the CapEx spend causes margins to drift down to around 25% by 2030. Put that 25% on $464 billion of revenue and you get around $116 billion of net income. Now put a 20x multiple on that, which for a business like this is not too aggressive, and you get a market cap of $2.3 trillion. For simplicity, I've held the share count flat, so buybacks and stock-based comp aren't accounted for. For context, the share count has been trending downward over the last few years. So if the trend continues, that would be an upside to these numbers. But I wouldn't bank on it given the CapEx spend. So on today's share count, a market cap of around $2.3 trillion implies a share price of $911 versus about $594 at the time of this recording. So a 53% total return, or around 10% a year. That's roughly in line with the historical return of the S&P 500. But here's the thing. In my opinion, the assumptions here are quite conservative. Just look at what I left out. I didn't assume Reality Labs' losses narrow at all. That's another $16 billion a year of potential earnings sitting on the table. I gave them no upside for cloud or AI agents. I assumed margins went down a fair bit, and I held the multiple at 20x. But if in 5 years Meta genuinely has 2 or 3 business lines that generate a meaningful amount of revenue, instead of just one, you could argue that Meta deserves a multiple closer to 25 times. So let me flip a few of those the other way for an upside case. Let's assume that some of those initiatives start paying off, and revenue fades to 14% instead of 12%. Let's hold margins steady at 30%, assuming the Reality Labs losses slow down and offsets the extra depreciation. And let's re-rate the multiple to 25 times for the multiple business story. Now you're looking at about $147 billion of net income and a share price of around $1,440. That's a 142% return, or around 22% a year. That's a very good return. Now, those are relatively optimistic assumptions, but they're not entirely unrealistic. I think most likely the returns will sit somewhere between the conservative base case and the optimistic scenario. That said, as an investor, I think it's always important to stress test the returns in a more bearish scenario. Let's say revenue only grows 25% this year, missing analyst estimates, and fades to 8% by 2030. Now let's assume Meta continues to spend aggressively without clear monetization, and the higher depreciation causes margins to compress all the way down to 20%. And the market re-rates the stock to just 15 times earnings. Run that and you get a price around $480, down about 19% from here, or roughly a 5% loss every year. Of course, that's not ideal, but it's not catastrophic, and the assumptions here are pretty harsh. So to summarize, in my bear case, I'm down around 20%. In my conservative base case, I make about 53%. And in my high case, I make almost 2.5 times my money. Famous investor Monish Pabrai has a quote I love. He says, "You want to find bets where heads you win and tails you don't lose much." For me, Meta feels like that kind of bet. So I'm a buyer of the stock at this level. This is not financial advice and you should absolutely do your own research. I'll be making plenty more videos like this one, so if you found that useful, please do consider liking the video and subscribing to the channel. It would mean the world to me. I also make short form content on Instagram and TikTok, which I'll link in the description. Thank you for watching.